Good morning, everyone, and welcome to day two of the Actuaries Club of the Southwest Spring 2026 meeting. Before we begin, a quick reminder, please use the Q&A feature to submit any questions. We have approximately 200 attendees for this webinar, so unfortunately, we won't be able to use the raise hand feature, but we truly appreciate your participation and support of the club. So with that, I'm pleased to introduce the speakers for our first session, Qian and Lucy Ouyang. Qian is a consulting actuary at Milliman, specializing in hedging and financial risk management of annuities, asset modeling, and asset liability management. Lucy Ouyang is a principal at Milliman, specializing in actuarial appraisals, investment-related financial reporting, asset modeling, asset liability management, and capital optimization for life and annuity insurers. Qian and Lucy, thank you both for joining us today, and I'll turn it over to you.
Thank you. So today we are going to cover the SOA research we have done recently about a complex asset. And we do have a lot of material to cover today, so hopefully you have your coffee ready. Just to go over the agenda really quick, I'm going to go over the research background first, and then we will dive into each of the research topics we have done. And later on, Ken is going to do a deeper dive of the structured assets. Because I know for a lot of actuaries, we don't have a lot of knowledge on the asset side, but nowadays there's more and more focus on the asset, whether it's from like a regulatory scrutiny or if it's from the principle-based valuations. So hopefully this session will be helpful to you. So first, just some background on the research. This research was originally raised up by SOA committee, and they are looking for some support from the industry to help the insurance company to better understand the asset they are holding, especially as we see there's more and more structured securities in the company's balance sheet compared to like years ago, like 10 years ago, majority of the assets are focusing on corporate bond or commercial mortgage. That's why it raised this topic from SOA. And a team of us have been working on this research for a couple months. And on the research side, we're more focusing on like what's the driver for using more complex asset, including like the structured securities. And that's also our focus for this study. And then we also look into the common structure and the underlying collateral for different type of structured securities, like what's the underlying collateral for collateralized loan obligation, the CLOs, versus asset-backed securities, ABS, and mortgage-backed securities, MBS. And we also try to understand what's the key risk for different type of asset. And what is the market volatility for the complex asset compared to the most popular like corporate bond in the insurance balance sheet. And we also look into the history to see how does these assets perform in different economic environment, especially like during the GFC crisis, the Great Financial Crisis cycles. And there's also correlation study we have done among different structured securities, and also the correlation between these structured assets versus the public corporate asset. And in the research, we also touched on some liquidity management, but given the time, I'm not going to cover that today. And for this research, we have divided into two phases. The first phase, we did a literature review on all of the materials out there that's already been done by other people, and we're just like populating those together and summarizing those to have a better flow for the whole research. And for the second phase, we are interviewing different industry participants, including the insurance companies, and we also talk to the regulators. And we also have some interview with the asset managers who originated these structured assets to basically give a broader overview of how are these assets driving the company's strategic decisions. And this interview also covered the risk management practice, like how do company evaluate the risk for this asset, and how do they perform under stress scenarios and what kind of stress scenarios company would do. So with that, I'm going to take you to the trend for the investment for the life and annuity companies for the past 10 years. So on the graph here, you can see the most obvious trend here is this blue section and the orange section. Like you can see the blue section have basically shrinked over the past 10 years, and that's the public bond and public structure securities. And that basically get offset by the orange section, which is the private corporate bond and private structured securities. And we do see the private bond and structured have grown by about 10% from 20% to 30% over the past decade. And among those structured securities, the RMBS and the CMBS, the residential mortgage-backed securities and the commercial mortgage-backed securities, those two have been the most popular one in insurance balance sheet in the history. But then we can see on the graph on the right side, the RMBS and the CMBS, especially the RMBS, it has been shrinking over the past 10 years. And the growth majority came from the COO, the collateral loan obligation, and other type of ABS structured, including the more esoteric private ABS structures in the balance sheet. And we do see that have increased by almost 60%. Right now, it's about 60% of the total company holding as of year-end 2024. So what is really driving this growth for the complex asset in the insurance company balance sheet? The first very obvious reason is the yield enhancement. So for these type of structured asset, we do see a higher spread on those. And some reason is because of the structure, the way it's being structured, and it's illiquid, especially the private and esoteric ABS. They do have high return, but this is because of their illiquidity feature and also their bespoke structure design. And another reason driving this is also because of the diversification benefit these type of assets can provide. So instead of you are investing in a single borrower or a single loan, these securities, they will pull hundreds or even thousands of loans into this one pool and then collateralize that into different tranches, including like debt tranche and equity tranche. So this will give the investor a great diversification benefit. So even there's a few loans in the pool underperform, the loss from those few loans can most of the time be offset by the rest. And for COO, we will mention later, there's also a reinvestment period where the asset managers can choose to reinvest during that cycle to minimize the loss for the whole structure. And there's also the liability-driven reasons why companies are investing in these more illiquid assets. So for the insurance product, there are some products where it has a longer duration. So they are using the esoteric type of structured assets to lock in that period, and then they can gain from the illiquidity premium by holding these assets to mature. So for these type of assets, when company investing in these, they typically would want to hold it to maturity instead of sell it if they don't have to. So they can get the whole illiquidity premium at the end of maturity. And from the capital standpoint, company do see like if they were to hold the same underlying loan, which can have like say a triple B or even below ratings on their balance sheet, versus if they were to hold a structured security which has the triple B and below loan in the pool, as long as the structure has been set up properly with enough subordination, then there will be a higher rated, like the structure can be rated like AAA or AA, depending on the subordination you have in this structure. So from the capital standpoint, there are some benefit for holding these structured assets versus holding the underlying loan directly. But again, later on, we will talk about the regulatory scrutiny on this type of asset as well, and the update to the COO capital charges. And another reason we have found out is the partnership with asset managers. So in the past few years, like there are more asset managers acquiring the insurance companies, and there's also more and more collaboration with asset managers, not just between the insurance that's backed by the PE firm. Even for mutual companies, there's more collaboration with asset managers, which also increase life insurers' access to this alternative investment. And then diving into the different type of the structured securities. So for this research, we're more focused on CLO, MBS, ABS, and ABF, the asset-based finance. And most of the time, we refer that to the esoteric ABS. So the structure among these are very similar, where there's different tranches with that, like different rated tranches, like the debt tranche at AAA through double B, single B even. And there's also equity tranche for some of these assets. But then what different is the pool of the underlying loans are very different among these different structures. So for COO, for example, the COO, the underlying collateral for the COO pool mostly are leverage loans, and there's syndicated or middle market loans, and all of these loans are private. And syndicated will be more public and traded. But then for the middle market, those are all private, and there's very low liquidity to basically no liquidity for these COOs. And then for MBS, there's residential and commercial mortgage, and we have seen these structure in insurance balance sheet for a long time. And the underlying collateral for those would be either the residential loan or the commercial loans. And the ABS, most are from the consumer loan side, like auto loan, credit card, student loan, or equipment loan we have seen in the market. And most of these are also public. You can trade very easily. And on the ABF side, so this is more like a niche market where asset managers will originate those assets, and they are often backed by like aircraft leasing or solar panel, or there are whole business securitizations. And for these type of assets, it's more esoteric. And then the structure, we have seen like structure vary from different asset managers as well. On the cash flow side, so for COO, there are like the loan repayment, there's like a waterfall structure for the loan payment. So whenever there's loan payment in the underlying pool, like the cash flows for will basically go through the waterfall structure to flow through the AAA first, and then go to double A, single A. So it basically follow that seniority. And then whenever there's a loss happening, the equity tranche will get hit first. And then the loss will go up to the single B rating, double B rating, and then triple B. So it goes the other way, like from the bottom to the top. And we have also seen that's why, like for COOs, if it's a senior rated COO, the loss rate is very low compared to a more mezzanine tranche. And for the MBS, ABS, similarly, the structure is very similar. And for ABS, for ABF, we have seen different structures where there are some structure it's being like whenever you have the cash flow will get paid throughout the whole deal, like the whole slice. When we say it's kind of like you will get, if you have a cash flow available, the cash flow will flow through all of the tranches for a certain period of time. And then after a certain number of years, the cash flow coming in will go through the waterfall structure as well. So there's all for ABF, there's more customized structure compared to the standardized COO, MBS, or ABS structure. In terms of the risk and the return for COO, a lot of the COO are floating rate, and that's how it's being structured. And COO, given the underlying loans are, some of those are corporate loans, so it's really exposed the investor to the corporate credit risk. And for mortgage-backed securities, the potential risk would be the prepayment for these assets. And there's also, if it's a residential mortgage, then you are exposed to the residential housing market and also the interest rate risk. And for ABS, given the underlying loan are auto loan, credit card, student, these are more subject to the consumer credit performance and also very highly dependent on the economic cycles. And for the asset-based finance, the risk and return, so the return is higher compared to the rest of the asset for ABF, but it's first of all because of it's very illiquid. You cannot really trade this in the market. And also depending on like how the structure has been set up, there will be a complexity comes into the structure and as well as the transparent. It's not as transparent as the other structure. That's why the investor also will get a higher return on this type of asset. So now let's take a look at the COO structure. So COO structure, COO is most issued by the SPV, the special purpose vehicle, and it essentially have a pool of loans. And you can see on the right side, like with the green box, it has different rated loans in that pool. And when you, or sorry, on the left side, the pool, the pool have like a loan from 1, 2, 3, 4, 5. Like we can have as many as loans in there, and then it goes to the COO structure, the SPV, and then SPV will tranche those into different tranches, starting from like triple A and at bottom to double B and sometimes single B, and then you have the equity tranche to absorb the loss first. And then for the COO, there's typically a different, so for COO, there's different cycles among this whole investment. And earlier I mentioned there's a reinvestment cycle. So you can see from after the CO has been originated, there's about 4 to 5 years where the asset manager can reinvest the COOs. And during those period, and the reason they will, well, because of this feature, the COO is also exposed to the reinvestment risk. And that's different from the other type of asset if they don't have this reinvestment period. Because of the reinvestment period, if you are reinvesting a loan under the environment where the interest rate are lower and the spread is also lower, then you are getting a lower return compared to if you had this invested early on. So because of this reinvestment risk, this is also something the asset manager and also the insurance company needs to better understand. And because these CO are typically the floating rate, so whenever the interest rate are moving, the coupon get paid to the investor will depend on the interest rate movement as well. And then there's a couple new asset types we have seen in the market. I wouldn't say new, but like we have seen these two the allocation for these two assets have been increasing in life insurance balance sheet. The first one is the rated note feeders. The rated note feeders, it's very similar to a structured securities, but then this is essentially the insurance will invest in this rated note feeder, and then the proceed the rated note feeder is going to get invested into the main fund. And then as a return, you will get the LP interest, the limited partnership interest, to the rated note feeder. And because it is rated note feeder, like from the name, you can see they are rated, like the debt tranche for the rated note feeder fund is rated by a rating agency. So when the asset manager originate those deals, they will work with the rating agency to rate the debt tranche. And that way, when the insurance company invests in these debt tranche, they can get the bond equivalent RBC charge instead of the equity charge. So for the underlying loan for these main fund are typically unsecured compared to the COO we talked about earlier, which are backed by the pool of secure loans. And for the rated note feeders, the loan in the main fund are typically subordinated to any like senior ranking debt, such as the NAV loan. That's what we're going to talk about next. One of the benefit with the rated note feeder is because they are rated by the rating agency and company are seeing a higher return, but as well as a corporate bond capital charge. And the next will be the NAV loan, the net asset value loans. This NAV loan is a senior, and most time it's a floating loan secured by the net asset value of a private equity fund. So for this structure, it provides both the borrower, like the portfolio managers, the liquidity, and the flexible to fund additional acquisitions. And at the same time, the lenders, like the insurance company, they will get a higher return from this loan. And there's also a stronger downside protection, given these are senior loans. So they will get paid first if there's a loss happening. And the loan to value for the NAV loan is typically 5 to 30%. It does have a lower loan to value compared to the middle market direct lending, which has a loan to value of 35% to 60%, which means the NAV loan typically have a lower loan to value and it's more secure. And on these NAV loans, there's also a very strict covenant requirement where it can limit the borrower on taking additional loans when certain risk triggered. Sorry, the slide is not advancing. Yeah, so after taking a look at those, we also studied the potential risk for different complex asset. Earlier, I briefly mentioned the credit risk. Basically, the credit risk is a risk for all of these structured assets, depending on the underlying loans. Whenever there's a default of the underlying loans, all of these structured assets will be impacted. It's just depending on the tranche level. If you are holding a senior tranche, then your default risk will be lower compared to if you were to hold a subordinated tranche. And among these structured assets, the agency MBS also have a lower risk compared to a non-agency MBS. And the agency MBS are really referring to the MBS like the Freddie Mac, Fannie Mae, Ginnie Mac issued MBS, and those are supported by the federal government. And another risk would be the prepayment risk. So for the prepayment risk, like I mentioned, for the MBS and MBS, CMBS, those are and residential mortgage-backed securities. Those are all subject to the potential prepayment of the underlying loan, and those prepayment will essentially get passed through to the RMBS as well. So if you invest in say a 10-year RMBS, but then it end up prepaid, then you will only have 5 years left. And in that case, the investor will be subject to the reinvestment risk, depending on the market environment. There's also liquidity risk for these structured assets, given some of the structured assets are esoteric and private. And we talked about the reinvestment risk for COO already. Yeah, interest rate risk and the economic environment, especially for the fixed rate securities like ABS, MBS, when the interest rate change, the market value will change for these type of asset. But for COO, because COO are a floating rate structure, so it doesn't have interest rate risk that compared to this type of asset. And there's also valuation uncertainty, especially for the illiquid private structured, because those are not publicly traded, and there's a lack of transparency on their pricing. And most of the price for the illiquid private structures are not updated on a daily basis. Like you can work with like third-party pricing vendor to price your private credit asset on a quarterly or annual basis, but we have not seen company doing that on a daily basis. And there's also the servicing quality and the manager experience. This is highly related to the COO and the bespoke structure. Like experienced COO manager, they will be able to, first of all, they have more experience. And they also, whenever there's default happening, they will work with the lender or they will work with the borrower to work out those deals. And for the complex asset, since I mentioned a lot of these are private. So for the private, most of the time we will have the impression that these private assets are less volatile compared to the public asset. But one of the reasons we see that is because of the valuation I mentioned earlier, that they are not being priced on a daily basis, not like public bond, where you can see the price fluctuate from a day to day in some, especially on the stress scenario cases. But then because these assets are not being priced on a daily basis, the value, when you look at your quarterly statement, you can see the value for the private structured assets are probably not moving much. It's just because these valuations are mostly done by a model, like the discounted cash flow model. And depending on the interest rate you're using, and if it's set up to be a floating rate structure, then you are not going to see much movement based on the interest rate movement. And we have found some study. This is not directly related to private credit in that sense, but it is related to a private equity. Like there has been a study where it shows the NAV volatility for the equity fund, for the private equity fund. It's about 14%. That's their reported, which is lower than the market average of 16%. But then the true market-based volatility for those are actually close to 24%. And Moody's has also like a similar study on private credit, and they also highlighted there's an understated volatility for these private structured assets. Um, and when we look at the performance during the economic shock, we look at the GFC cycle specifically. We have some data for the default rate before the GFC cycle versus the default rate after the GFC cycle. And this graph is specifically about the COOs. And for COO, you can see the default for the COO 1.0, which are the COO issued before the GFC cycle. The default risk is very high, especially for the single B rated tranche. But if we look at the default rate for the COO 2.0, which is after the GFC cycle, the default rate has experienced a significantly lower rate compared to the COO 1.0. And we also look at the correlation for these complex asset, and we call it like inner correlation, which is essentially the correlation among these more complex asset. And there are some data from KKR. It look at the private credit, the global private equities, the US loan, high yield, infrastructure debt, real estate, and the private ABF. And we found the private ABF has modest correlation across all of these assets. And then the lowest correlation is between the US high yield and the real estate. And infrastructure also have relatively modest correlation with other type of asset. And the highest overall correlation among these assets are the US loans and the US high yield. And when we look at the correlation between these complex asset to the public asset, we have seen the direct lending and the asset-based finance, they have low correlation with the investment-grade corporate bond and the treasuries. And the US direct lending, they have the highest correlation with the leverage loans. It's because the underlying loan for these direct lending or especially if we're looking at COO, middle market COOs, the underlying collateral are the leverage loans. And lastly, I want to talk about the regulatory update. So recently, Academy has proposed some COO capital charges for different tranches, and NAIC is looking into that right now. And the potential change for these RBC, we can see for the higher rated tranches, the proposed RBC charge is actually lower than what it's currently we have. So currently we're just applying the corporate bond risk charge for all of the COOs. But with the Academy study, they have shown a lower risk for the higher rated tranches up to until triple or single A minus A3. So for A3, starting from A3, we can see the RBC charge will be higher. And this is more significant for the lower rated, especially the below investment grade asset. And with that, we do see some company are shifting their investment from the lower rated tranches to the higher rated tranches. And we expect to see the trend going forward. Yeah, with that, I'm going to pass over to Ken to do a deep dive into a sample structure security. Qian, hand it over to you.
Oh, okay, great. Thank you. Thanks, Lucy, for your overview. So now in my section, I want to do a bigger, deeper dive into a numerical example trying to illustrate the cash flow mechanics of structured securities, because certainly it can be confusing to think about the waterfall and sort of the different securities that insurance companies can own. So just, as a broad overview again, Lucy touched on this earlier, but with securitization, you sort of have three main steps here, where it's just a loan originator, which is, like a bank or any type of lender that's sort of packaging together all these individual loans, like auto loans, corporate loans, or mortgage loans, that goes into something called a special purpose vehicle or a trust that will, like from their balance sheet's point of view, the loans are like the assets, and now they're going to create these new securities that are what normally the insurance companies would invest in. So these are different tranches of these structured securities. You can view these as like the liability of the balance sheet, and then the investors are going to be the ones that receive the cash flows from these newly created securities that are ultimately backed by the cash flows from the underlying loans. But because of this tranching structure and the way to divide risk, it creates a better risk return profile depending on what the investor is looking for. So if we go on to the next slide, we can see sort of the typical structure of these tranches in these, structured securities here. You'll typically have the bulk of the par value of these structured securities being the senior AAA tranches that are definitely the lowest risk, and they're going to get first priority when you're thinking about the cash flow waterfall from the underlying loans. But they will typically have a lower yield as a result. But as you go down and lower down the tranches, you just have something called like a mezzanine tranche or like the single A triple B tranches. These will have higher risk because they're going to be supported by a lower amount of subordination. But then they're also going to get higher yield as a result to compensate for that additional risk. And you can keep going down, and the lower tranches will even get lower credit ratings, like a double B or single B. And the lowest tranche is just the equity tranche here, which would be like sort of the first loss tranche, but then they would get the largest potential return because they get all the cash flow that's left over after all the senior tranches have been paid. We're going to get into some of the key structural concepts that sort of provides the support that can justify, a triple A rating, for example, for the high tranches. There's things called subordination, which allows junior tranches to first absorb losses before senior tranches get hurt. There's also other credit enhancement techniques like over collateralization in reserve accounts. And there's also things like excess spread where the underlying loans pay a higher spread than the coupon payments that these tranches pay, so that there's also this additional cushion of spread that can flow through to the equity tranche. So we're going to do a case study here illustrating this. So in this case study, we're going to look at an auto loan asset-backed security transaction. This is a $1.6 billion ABS security here, where we have $1.6 billion of par value issued and is backed by 1.645 billion of loans. So that's the underlying pool of loans of par value. And there's about 110,000 loans here. So definitely a lot of loans and pretty diversified. But if you look at this weighted average credit score section, it's actually like a more of a risky loan pool because the overall credit rating is somewhat low. It's 600, so that's can be as subprime. And then the weighted average APR or interest rate can be thought of as really high here because it's almost 18%. So definitely like a really high loan pool. But we can see here that on the next slide, we're going to create this tranche structure so that you can still have triple A rated securities that are backed by this loan pool. So, this is just another view of the details of the loan pool. If you go to the next slide, this is the tranche structure that is created here for this sample pool here. And the idea here is that tranche A actually should have the highest par value of the securities. And as you go down the tranche schedule list, the coupon rates of the tranches will start to increase. And you'll note that this credit support column starts to decrease there as well. So the idea here is that each of these tranches, as you go from A to B to C to D, they're getting like lower and lower in credit rating, but then giving like a potential higher yield as a result. Um, and the key thing here to also note is that the exact percentage of the deal, I think for tranche A is actually maybe close to 60% of the deal here. So this is typical in most structured securities where the highest senior tranche does make up the bulk of the pool here. And so I think part of that reason is because a lot of these insurance companies want to invest in highly rated, safer assets. And so there's just higher demand for that. And I think just by nature of that, there's more weight given to these higher rated tranches when you're looking at like allocation to par value. But now let's get into detail on how you actually calculate this credit support, because this is a metric that one typically looks at when thinking about like how much support in subordination does a tranche typically get here. So um, first, though, when you think about the credit enhancement mechanisms of this, the subordination is definitely the big one here, and that's talking about that credit support that you saw on the prior slide, which really refers to the fact that the underlying tranches that are below a given tranche need to absorb losses before the senior notes get hit. So that's definitely a big thing, and obviously, the higher you are in the tranche priority, then the more support you get from it because there's more par value underneath that tranche that needs to get wiped out before that tranche gets hurt. There's also concepts though called over collateralization and reserve accounts that we'll get into shortly. But I also want to point out that there is a large excess spread here. If you recall, there's a weighted average APR rate of 18% on the total underlying loans. But if you actually look at like the coupon rates of these individual tranches, they were nowhere near this amount. So if you sort of subtract the weighted average coupon rate of the tranches from this interest rate of the underlying loans and also deduct like a servicing fee that's typical charge for these structured securities, you're left with about like 9.5% of excess spread here. And so that's also excess cash that gives you additional cushion so that if there are some underlying defaults that occur in the underlying pool, like this excess spread that you already sort of baked in here provide some additional support um, that you can afford, and so thus the cash flows of the underlying tranches may not get impacted if there are defaults. So yeah, if we go to the next slide here, um, yeah, so this is just another view of the tranche structure that we outlined in the earlier slides here. We have the 6 different classes. So the initial pool here is $1.645 billion of underlying par value of the collateral loans. And when I talked about the credit support here, we recall that Class A had the highest credit support. And the exact way to calculate this is you want to sum up the par value of the subordinate tranches as well as over collateralization and reserve amount here. So, for example, for Class A, um, we saw in the previous slide that has 41% credit support. And so the subordination then, you would calculate that by summing up the par value of the um, 5 tranches that are below it, so B, C, D, E, and F. That sums up to about 612.9 million. And so you divide that by the total underlying par value of the loan, and that gives you about 37.25% of just subordination support from those tranches that are underneath it. Um, there's also something called over collateralization. What over collateralization means here, this OC variable, is it's the difference between the total par value of the tranches that are issued divided by or is the difference between that and then the par value of the underlying loan pool. So the underlying loan pool had a 16.45 million par value, but the total par value of the tranches was only adding up to 1.6 billion. So that gives you a 45 billion additional cushion there that supported from the structure. And so that gives you a 2.75%. And then there's also this cash reserve account that's also normally set up when in these structured deals that can be used as a backstop for any losses as well. And so if you add these percentages together, you get this 41% number here that we're quoting for the support for tranche A, which is viewed as high here. And it's high when you compare it to the support for the other tranches. So if you look at, Class C, for example, the OC and the reserve support percentages are still the same, but the key difference now is the subordination component because you can see here that with Class C, it has a much lower amount of par value underneath it. You only need to sum up the par values of Class D, E, and F to get $325.8 million of underlying par value that supports this tranche. So that gives you 19.8% there, and you sum that up together, you get about 24% of credit support. So this is just reiterating the fact that the lower you go on the priority ladder, the lower the credit support will be. And thus, another way to think about this is if you have about 24% of the par value of the underlying loans default, then like investors in the tranche C will start to get their par value impacted as a result because there's just not enough support there. But tranche A has high enough credit support to not get hit. It requires a much higher level of total defaults on the underlying pool to get impacted. All right, if you go to the next slide now. So I mentioned this reserve account on the prior slide. In this example, we just set this as a cash account that's equal to 1% of the initial pool balance here. So $16.5 million in this example. This is something that's normally funded at the time the structured deal is created. And this is can be viewed as an account that can be drawn upon anytime there's a shortfall where you need to pay the note holders. It's a little different from over-collateralization because over-collateralization does not actually mean cash. It just means the difference in par value between the underlying loans in the pool and then the par value of the tranches of the structured security. But the reserve account is liquid cash that you can use immediately. So we can look at an example on the next slide to sort of see how this could be helpful. So for example, you could have a month here where you receive like 10 million of cash from the underlying loan collateral and you owed the note holder, so the investors in the tranche is 9 million. Maybe that's just interest payments and any principal owed. So in this example, you're actually good because the cash flow from your loan collateral covers that. And so you have additional excess cash of 1 million here. And if the reserve account is already full as well, then maybe this 1 million surplus can just flow toward building over collateralization and then equity. And so that maybe the 1 million could be used to pay down excess par value or it just goes to the equity tranches. The exact order may depend on the specific details of this contract. But if you have a case where there are some underlying defaults and maybe the collateral cash flows decreases to $8 million in this year, but you still owe the note holders 9 million, then you actually have a shortfall of $1 million. And in this case, you can draw this $1 million from the reserve account to cover the gap so that from the point of view of the note holders or the investors in the tranches, they don't really notice the default because they still got all the cash flow they were promised. But you're using this $1 million to fund it, you would just take it from the reserve account. So this reserve liquid cash account drops to $15.5 million as a result. And then later on, if things go back to normal again, you can divert any excess cash back to funding this reserve account to bring it back to that target level, 16.5 million again. So this is just an example of how that reserve account could be helpful. In this table here, just sort of summarizes these cash flows again that I described. There could be cases where defaults are so large that the reserve account gets wiped out, and that's certainly possible. But this is some nice liquid support here that can be used from time to time. All right, and I mentioned how over-collateralization is different from the reserve account, though, because over-collateralization is not a liquid cash account, but instead can be thought of as just the definition of the difference between the par value of the underlying loans in the pool and then the par value that's been issued to the tranche holders. And normally, you have some initial over-collateralization level. Like in this example, it was 2.75%, where I'm taking that 45 million gap between the par values of tranches in the underlying loan pool and dividing by the total par of the loan pool. But oftentimes we actually try to build up that over collateralization to a higher value to build additional credit support. And normally the way this is done is, you have excess spread coming in from the underlying loans when the cash interest is paid, and you actually tend to like pay off the par value of the senior tranches pretty quickly. And so you pay off down the par value of the senior tranches in a way so that your over collateralization will increase. Because if you think about it, if you have high interest payments coming in, the par value of the tranches can reduce, but then the par value of the underlying loan collateral pool will stay the same. So the denominator stays the same in this over collateralization equation, but then the numerator decreases. That results in a sort of a higher ratio there. There could be cases though where you have large defaults, and that causes the over collateralization to get, to decrease or completely get wiped out. Because if there's a large defaults, then maybe you have to mark down the par value of the underlying loan pool. But that doesn't necessarily mean that you haven't marked down the par value of the tranches themselves. So there could be even bad cases where the par value of the underlying loan pool is less than the par value of the tranches, and that would be certainly a problem. We can see an example later on of how that impacts cash flows and the cash flow waterfall. So if you go down to the next slide, we're going to do one more numerical example showing the cash flow payments and something called a par coverage test, which can be used to divert payments. And that provides a further illustration of how a senior tranche can get protected when it runs, when the underlying loan pool runs into trouble. But basically, when you think about like what needs to get paid first, oftentimes the first part of this is just paying this 4% service fee that I think is typical for many contracts. And then after that, normally the interest payments of the individual tranches come in first, in order of priority from Class A to Class B to Class C. And then after that, some money will be used to pay down senior tranches. This is part of that thing I talked about earlier with trying to build your over collateralization ratio to a certain level here. And that's like replenishing the par value of tranches based on sort of the schedule that is expected. But there's going to be a par coverage test that we'll get into in the next slide, where if that fails, then payments are diverted away to from like interest payments, even for junior tranches, to pay down the par value of the senior tranche to make sure that you satisfy this certain ratio. And then after that, you can make any other remaining payments to restore the reserve account and also release funds to the equity tranche. Now we go on to the next slide. So let's look at like a case where all the cash flow is coming in normally. You can see the breakdown I've added in the box on the left, but ultimately what this comes down to is you have 33.5 million of cash income coming in from the underlying loan pool. And we can distribute it to the different tranches here. I've calculated the interest payments that are due for each of the class tranches, and it turns out that there's enough money to pay out the interest. And then after that, it turns out that tranche A had to get some principal repaid. So this 28.9 remaining after interest is paid is used to pay down tranche A's principal. But when we are determining if we need to pay each tranche's interest amount, there is something called this par coverage test that's done. And basically what you're doing here is you're comparing the par value of the loans underlying like that are below the tranche. Or sorry, the loans that any par values above that given tranche level, and making sure that it is less than the par value of the underlying loan pool. And if that is satisfied, then you satisfy your test and then you're okay. And you don't need to divert any payments. But if you go on to the next slide, we have a case where this test will actually fail here. Yeah, so Lisa, can you click one more slide there? I think we will need that. Yeah, so in this example, we had a lot more defaults occur. And so there's only $7.5 million available to distribute, so much less than the prior amount from the prior slide here. And you can do the par coverage test for the first three tranches, and you actually see they pass here. Note that now we're comparing to a 950 million underlying collateral pool value here because that is an assumption that was being made with a lot of defaults that are occurring. The underlying par value was just marked down for the underlying collateral loan pool. And now it turns out that if you look at like a tranche D, the sum of the par values of A, B, C, and D ends up being 1.089 billion, which is greater than the underlying loan pool of 950 million. So now you're sort of like underwater here at this point because when you get to tranche D, the sum of the par values of all the tranches up to that point is now greater than the underlying loan pool. So think of that as almost like negative over collateralization up to that point. And so what you need to do here is sort of divert payments to make sure that at least the senior tranches get their par value paid. And so this is a case where the par value coverage test fails, and then you divert this 3.9 million remaining of excess cash that you can distribute to pay down Class A. And so Class D, E and F don't receive any interest this month. So this is just another way to protect tranche A to make sure that at the very least, even if there's underlying defaults, all the lower tranches absorb that hit, and then Class A still gets their cash paid. Um, Now you can go into a lot more numerical examples of variations of this, and it can get quite complicated, but this is just trying to illustrate here an example of a diversion technique when you have a stress scenario, to make sure that Class A still gets the money they need. And then, yeah, it will keep going on to make sure that, Class B and Class C also get their par value retired first. You can run simulations here to see like what happens to the cash flows underlying the different tranches for different stress scenarios. Maybe, you can have a stress scenario where it's like 20% defaults, or you can have a very large stress of, cumulative net losses. That's what CNL stands for here for, 45% of the underlying loan pool. And normally when the rating agencies are trying to rate these tranches, they're applying these stresses and making sure that like even under a 99% VAR stress scenario, like Class A still gets their par value protected. And you can sort of see the range here. When you get to a higher and higher level stress, the higher tranches start getting hurt a little bit. But in this case, tranche A was still safe. But certainly there could even be a case where eventually, if you have cumulative net losses hit a certain extent, even tranche A will start suffering losses too. Um, but no, overall, this is sort of just a nice illustration here to show the variation and sort of when tranches start facing losses. So I think that is the last part of my slide. Lucy, you go on to the next one. Yeah, so I think we've concluded our presentation. So thanks for listening, and now I think we can try to address any questions that came up.
Yeah, thanks, Qian and Lucy. We have a few questions. The first one is prepayment risk significant, and how does it compare to credit risk?
Yeah, so for prepayment risk, especially for the residential mortgage backed securities, because for residential mortgage loan, like the underlying collateral for the RMBS structure, for residential mortgage loan, there's no like a penalty if you prepay your loan. So therefore, for RMBS, the prepayment risk is very significant and it's very highly sensitive to the interest rate movement. Like when the interest rate goes down, like people will try to refinance their residential mortgage, and that's why we see a lot of prepayment during low interest rate environment. But on the other side, for CMBS, like the commercial mortgage-backed security, because there's prepay penalties on the commercial mortgage loans, therefore we do see limited prepayment or at least not as sensitive as the RMBS. But compared to the credit risk, that's like just two different type of risk company need to be mindful of. Like for the credit risk, that's based on the credit of the underlying loans as well. And when there's like a stress environment like GFC, for example, during GFC, we have seen a lot of default on the RMBS and CMBS side. So that's like two different type of risk company needs to be mindful of.
Okay, thank you. So the next question is, noticed New York was not in that state list in page 22. Is there a specific reason for that?
Sorry, page 22.
Yes.
Sorry, trying to go back. This one?
Is there a page with states list?
Oh, yeah, I think you're talking about the prior slide to that. I don't think there's necessarily a reason why New York was not on the list. I think it just happened to be this specific example didn't have much New York loans. I think that's maybe what the question was referring to. So no particular reason. It's just that would be the loan profile.
Got it. Okay, so the next question is there some sort of analytic formula or some other data-driven judgment used to decide how much the coupon rate of the lower tranches should increase relative to the other tranches to account for the higher risk? Or is it just priced by the market?
Yeah, I don't think it's necessarily even like Priced by the market. I think it's sort of like when I think of priced by the market, I think like it's supply and demand between many traders. I think it's really just set at issued by the people, the special purpose entity creating the structured security. It's probably, I would imagine there's some maybe simulations going on to try to look at like what would be a fair coupon rate to get, the yield you need. But
Yeah,
yeah,
I can
Lisa, I don't
add
know if
as
you want to
well.
comment further on that.
So yeah, when we were talking to the asset managers for our second phase of interview, they have highlighted there's both ways. So there's basically like a market pricing for depending on what's the demand in the industry right now, like what insurance want, right? And if they were to price something not competitive enough compared to other asset managers, then the insurance company probably won't invest in the deal they have structured. That's why there is a market demand driven component when company pricing these deals. But then there's also a mathematical model asset managers do use to look at like what's the underlying collateral loans and what are the coupon they can get for each like for different type of the tranche.
Okay. And then the final question we have for today would be, who funds the reserve account initially, and where do they get the funds from?
Yeah, I can answer. Oh, yeah, I can answer that one. I think it's typically just funded at initiation, and I think it's normally like during the transaction when the underlying loan pool is transferred. I feel that maybe either a certain percentage of the cash of the underlying loan pool is carved out to fund the reserve account, or maybe there's some investment upfront to do that. But it's sort of something that all happens at sort of time zero, as the structure is getting created. For that.
Okay. We actually got one more question, and I think we can squeeze it in. Are there any industry studies performed to collect default and prepayment experience for complex assets to inform asset adequacy analysis, assumptions, and margins?
Yeah, so for the public structured securities, there are industry studies. Like rating agency have done extensive study on those public structured assets. But for structured securities, there's unfortunately not much industry study. The reason is because these assets are less transparent to the company, or yeah, to insurance and also to the industry. That's why, and there's also a challenge right now with the private credit is different company, like different asset manager originate those different deals, and sometimes the format can come in different ways. Therefore, like there's definitely a challenge to collect the data for different type of the structured assets and come up with a study. But there are some study like regarding to the default rate for like the CLO and the middle market loans out there where company can look at, but not like I would say like a similar study like Moody's have done for public structured assets.
Okay. Well, thank you, Ken and Lucy. That's all the questions we had for the session, and I will hand on to Linda for the next speaker.
Yeah. Thank you.
Thank you.
Thank you, Lucy. Thank you, Ken, for your presentation.
Thank you. Bye-bye.
Thank you. Bye.
Hi.